Good morning, it's Jeff Christian. It's Happy Lunar New Year for those of you celebrating Lunar New Year. It's February 12th, about 10 a.m. in New York. CPM Group has just issued a new trade recommendation for short-term trades, something that we do. It's available on Kitco and GoldX app, and from CPM Group, I guess, too. Our view earlier this week, when the price was around 1845, was that the price could drop down to about 1825 and maybe lower. As we're speaking, it's about 1814. Our view still is that there might be a little bit more downside on the next day or two, especially because Monday is a holiday in the United States and Canada, which will reduce the trading volume and liquidity in the market. So we could see the price come down to 1805 or maybe even 1800. But basically, the gold price has been trading between 1800 and 1880 since it dropped sharply on the 6th of January. There was a spike down to 1785 last week. And our expectation is that by and large, the price will continue to trade between 1800 and 1880 over the next few weeks. So it could be a little bit down, come down a little bit. It could test 1805, 1800, maybe make another dip down. That drop down lasted less than, well, it spanned 2 days, but it probably lasted less than 24 hours last week on the 4th and 5th of February. You can see those kinds of spikes down, but we think that the price probably continues to trade between 1800 and 1845 in a narrow range, with the possibility it moves up to 1880. Longer term, we're still optimistic that the price will move higher. There are a lot of things happening in the gold, silver, and platinum group metals markets right now. Big transformational developments in some cases, and cyclical and seasonal and secular changes in other places. And it's interesting because some of the big developments are not being talked about in the market, as if people don't know they're there, or they don't want to talk about it, or maybe they just don't understand exactly what they're seeing. In the gold and silver markets, one of the big things that we've seen is over the last couple of years, banks have been pulling back from the bullion trading, and they have reduced their bullion trading activities and staff. In some cases, they've even closed their bullion trading departments. That has reduced the liquidity in these markets, both in terms of depth and breadth. And you also see a rise of Chinese banks as becoming major bullion trading operations, and Canadian banks as banks elsewhere have scaled back. And you've seen this liquidation, this reduction in liquidity in the markets as a result of that. And it's not really being addressed, but major mining companies and users of commodities are finding reduced services in the financial intermediary sector, and medium and smaller companies and investors, and even some billionaire investors, are having increased difficulty finding financial services related to bullion. And that's probably added to the volatility in the market a little bit on a short-term basis. It'd be interesting to see how that plays out over the next several years. Related to that, as some of those banks had stocked up, well, bullion banks and dealers are market makers. They stand to buy or sell depending if whether their clients want to sell or buy. And what we saw in 2018, 2019 during the bear market was a lot of gold and silver showing up on bullion banks' balance sheets because they were net buyers. And they were hedging those physical positions with COMEX futures or options, or in some cases they were hedging it with ETFs, which they sometimes will do, since the ETFs came along in 2004 for gold, 2007 for silver. What we saw then was a surge of metal into bullion dealer inventories in the early part of 2020 as the pandemic and economic lockdown occurred and the prices fell sharply. You had a lot of selling by investors, disgorging inventories, taking advantage of what had been higher prices and getting out as the markets fell. And that metal backed up in those bullion dealers' inventories and balance sheets, just as their senior management was saying, hey, we want to reduce our exposure to precious metals, not increase it to record levels. And you've seen record levels of inventories in New York, in London. You don't see them in Zurich and Shanghai, but they're there. I guess maybe there is Shanghai data. We've seen record levels of large bars, 400 ounce, 100 ounce gold bars, 1,000 ounce silver bars in those inventories. And one of the things that's happened is that the banks were selling some of that metal because they wanted to reduce their exposure and buying ETF shares. So you had this massive surge, 300+ million ounces of silver ETF shares being created last year between April and August. And then you also had a big increase in gold ETF shares. And a lot of that was investors buying because they were bullish on metals because of the pandemic and the economic lockdown and the political dysfunctionality, both in the United States and on a global basis and in other major places. But some of that was actually bullion banks disgorging their metal. So they sold the metal, they bought ETFs shares, and then they transfer those ETF shares to the equity trading desk because the bullion trading desk doesn't hold equity shares. And then after August, September, you saw some of those ETF shares being sold as the banks reduced their overall exposure to precious metals. That doesn't seem to have been picked up in the market. You don't see discussions of it. Obviously, bullion banks don't want to talk about it because it's unpleasant. But you don't see the marketing groups and the people they use to write about what's going on in gold and silver. You don't see them talking about it either. I have seen just this week some evidence that they're at least aware that it's going on, but they don't really have a good idea of how large of a factor it's been in the ETF market. But it's fundamentally changed the ETF market. The ETF market never really was a good surrogate for investment demand because in some cases you have different types of investors in ETFs than you do in bullion. And it's probably something that's going to be around for a while. I don't think it's a permanent change. I think it's just something that people ought to be aware of. The other interesting thing was if you look at central banks are price sensitive compared to private investors. As the price of gold rises because private investors are buying more, central banks pull back. And we saw a sharp decline in central bank buying on a gross and a net basis last year. Turkey was the big buyer. But if you take out Turkey, your net purchases of gold by central banks was probably about 2.4 million ounces last year. And big buyers like Russia stopped buying after the oil price collapse in April. China really hasn't been a big buyer. Kazakhstan, which was a consistent buyer for years, actually was a net seller. And you saw increased sales by central banks too, taking advantage of the higher price and raising cash because of the economic crisis that was going on. Turkey accounted for about a half of the net purchases and maybe 60% of the gross purchases. And what you saw in Turkey was that the Turkish central bank, which has taken a very intelligent approach toward gold and using gold as a monetary instrument, was offering gold bonds to individual Turkish citizens and corporations and saying, if you own gold, you can buy these bonds and pay for them with gold. Now you have Turkish lira bonds, you have liquidity, you have cash that you can live on, and you can always buy the bonds back and get your gold back. A very intelligent way to do it. India does this too. And we've seen this as a transaction, and you really haven't seen it well analyzed in Western press. And obviously in Turkey, it's gotten a lot of attention. And it was about 6 million ounces, I think, at the peak. Some of that stuff has now been bought back. The gold has been bought back and the bonds have been redeemed in the last few months of last year. So big developments that are kind of being overlooked in the market. There is another development which is being misunderstood, which is, the disconnect between retail products and wholesale products. as I said earlier, we have record levels of wholesale bars, 1,000-ounce silver bars, 400 and 100-ounce gold bars. But you have tightness in the minted coin markets. And people are saying, well, there's a disconnect. It's not a disconnect per se. What you're seeing is strong demand from smaller investors and larger investors for coins. And that has come at exactly the wrong time for those coins being minted. So if you look at a mint, a lot of the mints and private refineries have gone to modified work schedules. And they'll have a third of their staff coming in at any given time, so that if there's a COVID outbreak, you limit the infection to a third of your staff. And you have teams that are sort of cohabitating the minting facilities. And that means that you're producing about a third as many coins as you could. So you have a reduction in the production of coins exactly when private investors want to buy them. And it's wholly understandable. And it's probably not being really well explained in that market. And then in platinum and palladium, we have platinum prices now rising and trading around 1,200, which is something that we had said we thought would happen. And you're starting to see much more bullishness in platinum. It's really been emerging over the last couple of years, but it's starting to have an effect on the price. It's not just investors that are probably buying more. The auto industry is also buying more platinum because it's moving away from palladium intense catalysts to more platinum intense catalysts, both in diesel vehicles and in gasoline or petrol powered ICE engines. And it's recovering from lower sales last year. So a lot of really big, interesting developments in the markets. And in the meantime, we're sort of treading water, waiting for the spring to come in the gold market. That's about all I have for now. I'll talk to you next week.